Gotcha. That this thing is fucked up. I don't know what's wrong. I really do not know what's wrong. So I want to focus on the price reading in this. Price reading is solely about you understanding why price did what it did at that specific point. With price, it moves with an absolute order. For instance, at this level, price moved here because of the mere fact that
Yes.
sure.
Solar veil, the screen. Yeah. Still not. Solo sharing.
Okay, please confirm myself.
Okay. Yeah. Saya veil.
Okay. So, because you have a difficulty of the non-track and stuff like that. So I would use this pre-analyzed chart. So each and every time I look for a trading opportunity, what I perceive as a trading opportunity is solely based on the market's behavior. First things first, I look at the supply levels. The red ones, these ones. This is supply level in the high time frame that hasn't been reacted on. All these are the supply levels. Now currently price is on this supply level. You understand? Then now there's this demand level. Probably price will react from this supply level to here, or fake out to this one to here, or do that to here. Nobody knows. You can't predict the market, but you absolutely have the order to say it has to bounce from this floor to that roof, or from that roof to this floor. That's solely what is about reading price. There's absolute order in the market, just that people they don't actually pay attention to what's happening. So you have to first identify the clean demand levels. Reason why I didn't draw this demand is because it was taken out here. Reason why I didn't draw this demand is because it was taken out here. So this is the left demand. This the only two demand levels that are left out in the monthly time frame. So I was talking about analyzing and each and every movement that happens in the price tag. There's absolutely reason because after a structure break right here, price retraced exactly to this point. That's where most of activity were in. This is a hidden base of the market. That's a hidden base where price reacted to. Same here, this was an SR flip. This demand here wasn't fully taken out, so it managed to push price even lower. Same with this. This is the supply level that managed to push price even lower. So those are the things you need to understand the caps of the market. You need to understand the rally-based rallies or the drop-based drops of the market. So that's why price managed to penetrate and clear this demand level. After it cleared this demand level with this penetration, it rallied up and created a fake out, then based, then dropped. So there was absolutely every reason for price to come back here and now causing a reaction. Same when the structure got broken here. Same with this one. Before price broke that structure here, it created this base first, then broke the structure. It's aligned with the previous structure. It absolutely makes sense for why price reacted to that point and then eventually break structure. So this is what we always look for in the market is the how the market plays out in each and every now. So we analyze the monthly time frame, we analyze the major zones within the monthly time frame. Then we analyze the weekly. The weekly are used lines. This is a zone that hasn't been, you see, within the monthly time frame, we looked for a weekly zone that hasn't been penetrated through. As you could see, this zone is still fresh. So we trade in fresh zones whereby people, when they put their stop loss, you have to put your entry point. That's why you see this zone hasn't been fully penetrated by the market inside here, because you could still make this zone a little bit low higher like this. This right here was a failure to return. That's why it has been penetrated by this doji, and this doji has been penetrated by this one. And this one has been when price engulfed this point, it was able to create this point whereby price, you see here, there's a lot of demand that actually price engulfed on, and that's demand, we call it an SDE. That's why the material that is being sold, it is sold to enable you to to have an idea of the market behaviors in each and every time frame. So you need to understand each and every move that is happening within the market in each and every time frame before you make a trade. So we're going to analyze this one until we have a trading opportunity at whatsoever time frame. The red lines, they stands for a supply level within the week. They don't appear in the monthly time frame because they're starting from weekly downwards. The blue lines, the only signify the demand levels within the monthly time frame. So you need to understand the movement of each and every time frame first. You see, previously this demand was taken out at this level, and this demand level was taken out by this week. And when price returned here, it fully penetrated and took out those orders. Now it faked out to a demand level that was never reacted upon at this zone. Then now the demand level has been taken out by this one. So this is the left demand level because price also based here. That's why in the monthly time frame, this is the demand. In the weekly time frame, this is the demand. I didn't draw this demand because already it has been tested. I didn't draw this demand right here because already it has been tested. I didn't draw this demand right here because already it has been tested. What does that mean? It means price is compressing. When it's compressing in towards a monthly demand level and monthly supply level, it means that here there might be a reaction, like we said, that might cause price until the end of the compression. Your targets were here, and after that it's risky to continue to sell because now you could continue to sell until this certain point. Then continuing to sell at this certain point now becomes risky. So one thing you need to understand is to know what's I'm selling or I'm buying from this point to the next point. I'm buying from this point to the next point according to what. Now you're following the smart man. The whole process is for you to follow the smart man. So what happens to the daily time frame? On the daily time frame, we could see the fact that price has already penetrated through the demand, through the supply level of this daily time frame. You can see inside this supply, this dotted line signifies that this is the decision point of this zone, the whole zone from monthly. As you could see, this is from the monthly. Now we are on the daily time frame. Price eventually just kissed inside here. Now we know we have to sell, and this is the compression that I was talking about from the high time frame. This is the compression. Compression is also part of the material that is being sold. They explain to you why price move like this. The movement of price doing all these ups and downs, it actually signifies that price is creating liquidity. As you could see, the last demand level hasn't been tested. All the other demand levels going up there has been tested. So what can we expect now? We can expect price, after reacting to this decision point within the supply level, to shoot down with a greater momentum because price has cleared, or it has created liquidity and cleared all the orders up here. All the orders, there's nothing to hold price to push it up. I think the only demand level that will be left, this one right here, price will bounce from it and create a lower low, then eventually price would eventually go down with a greater pressure or greater momentum. But that is being explained to at length. Now, what do we have? We've got this point. This point has been engulfed now. This is called a pin engulf. So that's also being taught about. What does that mean? It means price when it comes back here, it might not engulf this level. Price might come back at this level and react to it. So you have to monitor price when it gets back to this demand level right here. When it gets back to this demand level, it means you don't actually just go gun blazing and buying the market because price has created a high. Now it created a higher high, and this is a high low. So price when it comes back here, it might react. That's why your take profit of these cells are supposed to be here because you understand why that happened in the past, and this acts as an SDP. So right now, how can we get involved in this market? Because with that being said, now we're looking for a trading opportunity on how we can get involved with this market. So that's when the top-down analysis starts. We're starting from the daily time frame. We'll go as low as we can. If you can go to 1 minute down to as 1 minute, you can. So from 4 hours. For us, we can tell that there has been a structure break, 1, 2 structure breaks. So now we're anticipating for a retracement as price it looks to retrace inside there, then create another lower low. Because we know for a fact now we're supposed to sell, but there is no much information because price isn't moving that much in the lower time frame. So now there's this. Then how are you going to trade this? Because we're trading market patterns. Market patterns are the SDEs. Market patterns are the KLOU, are the 2 RFL that are being sold to you. So this is an SDE. This is a demand level, significant demand level. This is a rally, base rally, and there are multiple reactions here. And this demand has been engulfed. That's why it's called an SDE. And this demand level has given us a structure break, which is a confirmation that price must be going down. Going down to where? We don't know. But our safest place to place our target is here. Already we have defined the target. Okay, cool. Where can we enter the market? We go down even lower to scan for an opportunity of how to enter the market. Now we have the target, but we do not have an entry point because we need to decipher all the entry points and the stop loss before entry. This is an SDP, meaning going up there, we can't perceive that as an information that will be useful to us. Now we have an SDE. Remember the SDE that we had highlighted prior. Now we have that SDE. Now we have also got a KLOU. A KLOU is a key level. First, you have to identify the key level. This is the key level. Where price bounce at, that's the key level. There's multiple resistance, meaning we should expect a fake out to a true demand level. So above is the golden zone. What can we find the golden zone? In the golden zone, we could only find an opportunity to enter the market. Anything below the golden zone, meaning beneath the key level, is perceived as a manipulation zone. Anything beyond that, because price has created what they call a quasi-mode. This is a lower low, this is a low, created a high and a higher high. This is what we perceive as a quasi-mode. Inside the golden zone, meaning above the key level, that's why we're going to expect a trading opportunity. So where can we find the trading opportunity? It's still not clear. We can't perceive a clear decision point where we could say price will make a decision here to actually go down. Okay, this is what we have now, the information that we have about the market. Let's start again, drawing the things. This is a key level. That's the key level. That's the head. The head all the time is supposed to be held at an SDP. Like you see, this is a drop base rally. This is the drop, and this is the base, and this is the drop. It's a drop base drop. So it is held inside. That's an SDP. Now we have got an over and the under. That's the quasi-mode for you. That's a market pattern. So where can we expect for price to react? Now we have to do even a further top-down analysis, because you could see inside here, we could say this one has been taken out, and this hidden base has been taken out, and this is the only true demand level that has been taken out, because you can still reduce this supply level and to say this supply level hasn't been taken out yet. But that's not all about reading price. There's also, you have to read the information that is being provided by price as it approaches that zone that you are targeting. What is the kind of information? Firstly, we're talking about manipulation here, creating of the creation of liquidity. Price created a resistance here, created another resistance here. Now it's creating another resistance here. Support and resistance traders, when price get back here, they will sell. While breakout traders are looking for buying. So what will happen now? A fake out will happen. Where is price faking out? Price is eventually faking out to the true supply level where decision will be made. And that's where your target should be at, the next demand level. This is the next demand level. That's where your target should be at. Your entries, what have you done? You have defined your entry point. You have also defined now you have to define your stop loss. Your entry point is supposed to be inside there. That's why you do your top-down analysis. Now we go down to 5 minutes inside the selected box to say this one is your decision point, and actually find where exactly the decision was made. That's the key level. Now you're finding out a key level within your decision point so that you also execute where they're executing. That's how you get to have a sharp end. We started the analysis from a monthly time frame. Now we are at 15 minutes. You could intraday this trade now and make actually money out of it. So let's define the other variables that are left within the market. So from the market, we have analyzed that we need to make our execution within this area. Why are we making our execution within this area? Price started creating SDPs from here. It compressed away. That's the only fresh supply level that we have. All these other ones, they're not fresh. As you could see, even this one has been tested here. All the other ones are not fresh. So why do we say it's fresh? This one bounced at a support level. That's an SR flip. SR flip will result into a fake out. And then there was a compression. This whole area right here, it's a compression. Now we know that the true demand level is supposed to be inside there. So there are two things that you could do. You could do a top-down analysis within this highlighted area of entry, or you could use a key level to say, this is where there is more support, or this is where there is more resistance. So how can I trade price right now? It's simple. You look at where the keys are at within the market. You see, I straightly drew this one. So now that's the key level. So we're anticipating what's next about price. We're anticipating for price to push up here and actually move down there. So here's the twist about making money. So you need to decide one thing when you want to trade forex. You want to be right or you want to make money. That's the hardest decision you have to make, because one has the anatomy to say, in order for me to make money, I have to be right. No, you don't. In order for you to make money, you have to do what you're supposed to do. What are the rules that are being sold to you? It's the fact that price has to be held in SDP. It was held. Price has to have a key level. It does. It has an over. It does. It has an under. It does. It has a structure break. Even on the 4 hours, is a structure break. The PA, price approach. How is price approaching? There's a resistance here. They want to be a fake out, because now resistance people, they would sell again here. Breakout traders, they will buy against here. Now there was greater liquidity. Remember, price was also compressing towards this zone inside here. Now we're anticipating for price to get back into this point and then drop drastically to the next demand level that might hold price. So now the twist of it, it's the risk reward, because now we have an entry point. Now let's find out the now where we could have our stop loss. The stop loss is safer to have the stop loss at this point. Why? Because price penetrated this previous supply, and this is the last high price did before it dropped. So price breaking that high, it means that price now it is changing its course. You see, and our take profit is definitely at this point. So how's the twist of making money into the forex game? You see how much money you will be risking. You're risking this portion, this certain pips. You're risking this portion to make this portion. The risk reward. Let's calculate the risk reward. So if you make an entry at this level right here, exactly this point, and the stop loss is there, you're risking only about 6.8 pips. And how much pips are you willing to gain? It is 37. So 37 divided by 6.8, that's 5. That's a risk reward to 1:5. So what's the twist? The twist is if you're risking $10 in this trade, one trade, you're risking $10. You have a potential of making $50 from this trade at 15 minutes. You see, now that's the twist about the money management, the psychology about making money into the forex game. You have followed all the rules that you have done, that you are supposed to do. You have made a top-down analysis from the monthly time frame. Now we are at 15 minutes. Now you have calculated now you're putting into your risk management game. You're risking $6.8, 6.8 pips to make 37 pips. That's a 1:5 risk reward. So how are you doing that? You're risking $10 in this trade, and you are about to gain a potential of $50. That's the mindset that you need to have in each and every trade that you make. So I think right now I've broke down this trading opportunity. Then we should discuss what I have left out or what you lapho khona umlasele khona, so that if there was something that was left out or somebody got stuck somewhere, we should address it before I move on to make a second example. You can unmute or use the chat thing. It's quiet. Nobody's saying anything.
Hey, Nkosi,
Sure.
kanjani Nkosi?
Ingcono mnandi.
Siyabonga Nkosi. Hayi ngiyabona Nkosi, kuyafunzeka mani, kuyacaca.
Kuyacaca.
Mane Nkosi, sengikhala ngemvo yinye nami ngisitwa ukuthi lana le experience senginayo.
Sure.
Otherwise nje yabona lo mnye umuntu ngicangisa ngaba confused kakhulu ukuthi kahle kahle le supply nale demand lesikhuluma ngayo yini kahle kahle, ngoba
Sure.
phela wena most of the info urefera to le material oyidayisako and awufuni lokusitshela ukuthi le material kahle kahle iyini. Hayiva eve ngisho.
Sure, yeah, I understand.
Yeah, cause khona ngabona lo mnye nje longayadi nale supply ne demand, wena nje umtshela ukuthi okay na ngile yini le ndlela yakho eku-analyzer lona, and lo mnye aka-understand ukuthi okay ngiyambona analyzer but why akwende lokhu, yabona mvo leyo.
Sure.
At least usibriefe kancane nje le basic lakhona, cause nami sengiyibambe emoyeni ngenxa yethi okay I've seen this before, kuba kusiko lokho hawu ngabe kude lenkuvako.
Okay.
Alright, hayi kudingiya Nkosi.
Sure. Supply and demand. Okay, my bad. I had an assumption to say supply and demand is something that has been known. but it's quite clear it's valid. A novice cannot understand what exactly are we referring to when we're talking about supply and demand. There are basically two things that moves the market. It is the fear and the greed of either group. The greed of buyers, they create supply, meaning the sellers fear of price going even up higher will create a supply going down. Now they'll force price to go down. But the other thing, buyers, they come with greed. Sellers, they come with fear. That's the supply in the market, the supply and the demand in the market. Like we started to say, there are two people involved in the market. A two set of people. It is the buyers and the sellers. The buyers, they push price up higher. The sellers, they push price low. That's why you need to understand the structure of the market, that the breaking of the lows and the breaking of the highs. What does that mean? And what exactly are you supposed to be looking forward to into buying the market or selling the market? It's a great point to ask to say, if we talk about supply and demand, what exactly are we referring to? We're referring to basically two things. Sellers leaving a print or hidden orders to say they will come back to it. And by the time they leave those hidden orders to say they will come back to it, that's why you have to put your own pending order so that when they get back, they trigger their orders and they trigger yours in towards the other direction. They are against the buyers. Same with buyers. They leave those kind of trails. Like I said, everybody leaves a trail in the market. So what is it that we're going to do? Now, what he is asking is going to, how does one get to understand the supply and demand? You get to understand the supply and demand just by looking at the trails that are left. So now let me try explain supply and demand, how you can see it in the market. I'll start with the two key things within the market to understand the market. When the price go up, it will base, make a decision, store a moment, then drop. That kind of a drop is called a supply because there are a lot of sell orders that were left here, and the anticipation is that price will retrace and actually take out those orders. The twist about it, as you can see the way I drew, this is not the way it's supposed to be. It has to form a limping leg. The limping leg is price going up, creating that base, and then dropping. When dropping, it has to form a structure break for it to be a valid supply level. This is a limping leg. Like you see, this one is longer than this one, meaning there was greater sell orders here. And price shouldn't store or take a longer time here while basing, because it will mean there's nothing left for it to get back. By the time price get back to this kind of supply, it will just push it a little bit, then goes up. Why is that? It's because price took a longer time now here. The freshness of the zone, even if price retrace a little bit and retest it, then drop, is no longer fresh. The freshness of the zone, it has been taken away from it. This kind of supply level where price do like this is called a rally, price shooting up, and then the base, where price store for a moment, then the drop, where price eventually drastically drop from there. Then this is the rally base drop. You understand? The rally base drop is this kind of supply level. That's the first type of supply level. That is mostly where reversal patterns they take place. That's where reversal trades they take place. But if you are you are looking for a continuation. A continuation is always about price stalling like this, then eventually dropping like that. If price, the anticipation is that price will have to retrace back at this level and then drop. How do we trade this one? This one, there is what we call a maximum pain level. This is where price stall like this, create a small KOOU, then eventually engulf price like that. This little store right here, this little store is called the maximum pain level, and it's usually found in this zone. And you don't trade each and every drop based drop, but it has to be after a significant engulf of a support level. By the time you engulf a support level and then price come back and stall a little bit here like this on the H4, I think that will be a trade that I'll show that. And price engulf like that. Price, when they retrace here, that will definitely cause some sort of reaction. It doesn't have to engulf or anything like that, but price will eventually cause some sort of a reaction because this drop best drop has been formed alongside a great structural place or price level within the market of a support. That's why price has been bouncing for some several time in the market. You understand? So that's what we mean about that kind of a supply. Now that supply is out of the way, let's go to demand. The two types of demand. Price go down, store, make some decision, and eventually shoot up. When price shoot up like that, it is anticipated for price to get back at this level. And then that's why when we're talking about trading the market, when we're talking about market structure, we're looking at the highs, something like this. What do you do after price engulfs this? You're looking for a buying opportunity. The propagandas of forex say price will eventually engulf and come back like this, engulf and come back like this. It doesn't work like that. When you're really talking about proper structure, we're talking about structure like this, where price create a low, create a high, retrace back down, create another high, retrace back down, create another high, retrace back down. What do I mean by that? It's because price, like anything that is being sold, would you prefer to buy it at 50% off, knowing there's a chance for it to be 90% off? If you drag a Fibonacci level, that's like a range of prices. They say there's a golden zone, the 61.8. That's a little bit lower than the 50% of this whole move, because you're measuring this move is a little bit lower, but I use 90 to 80% because I know that's where the supply or the demand level in this case is at, because this is where the base was at. Then price created this limping leg. Now when it gets back here, I know I have close to 80 to 90% of the demand. Now the same story with this one. I look at the market, then I understand to say, oh, here the demand level that was here, it has been taken out, but there was a rally-based rally now that hasn't been taken out. It's fresh and it's aligned with the 61.8 level. Then it makes some sort of a sense. That's how we get to the rally-based rallies. A rally-based rally is price pushing up and then stalling in the middle here, and then eventually it pushes up again. The anticipation is for price to get back at this level. When it gets back at this level, it's supposed to react. Why? It's the same story as supply. When you look left, there might be bounces of price here in the past. There might be bounces of price here in the past. Even here, there might be. This is a significant key level. Key level is simply a level whereby price pushes here, in different time zones and different time frame. The level is the same. It has been pushing on the same level. This is the same thing that has happened here. The rally-based rally engulfed the price on the upside. There was a structural break and the retracement. When the price retraces at this zone, it will react at this level and eventually push up higher. When it pushes up higher, and now that's where we trade. Here, within this sector here where we're talking about, there's supposed to be a structure. The key level has to have a formal, because we're trading market patterns, meaning there has to be a KROU, something like this, where price create some sort of a resistance and create a low, and then eventually breaks out. Now that's the key level. Now we've got an over and an and, like the way I had shown in the previous analysis. When price get back here, it's supposed to react. There are some form of patterns that price has to show, like as a confirmation. There's a 3D. When price creates this 3D, it shows that. When price compresses, it shows that. When price create some sort of a resistance, something like this, it will fake out and show that. Probably this same pattern will be formed here again. And then price, people, when it pushes up here, now it is double, that's called a double cheat, because price will get back into this deeper level of the market and then eventually pushes up higher to create the new highs. That's all about supply and demand. It's about understanding where the others were fearful and understanding where the others were being greedy and how to utilize that. Because it doesn't mean when you find a supply like that, you just have to trade it. No, there has to be a market pattern. You have to understand that an SDE, the SDE that was here, the significant demand, it formed a new high, but it failed to create a new higher high. Now it started to form lower lows and eventually engulfed at its decision point. So that's how you perceive. And within that also pattern, you need to read and top down that thing until you get to say, this is where I'm meant to be selling. When price retraces at this level, this is where I'll be selling, and the target is the next demand level because it's supposed to cause some form of a reaction. Vele amathenje umtshele ukuthi, am I making sense?
Hayi siyabonga Nkosi, ayikevakala. Kuba uqale lapho-ke nje nale analysis ngabe ivele yabalula kakhulu. But sengiyakubona konke obukhuluma ngawo. Yabo kuba uqale nje lalo beze sokuchaza nyalo. Hayi nale analysis besitawuqhubeka silindele nalokutendele. Guys,
Okay, I think let's end the meeting, then come back again so that I show now Sesihamba in the same page on the next analysis, because I'm willing to analyze a second pair so that it could be clear. Come on.
All right, good thinking.
I think so. Huh? Okay. Ngiyavakala, ngiyabonakala. I want to confirm that.